What is going on, traders? Welcome back to the Traveling Trader. So was there insider trading associated with the release of the CPI earlier this week? There is some concerning data that came out showing suspicious activity, specifically in the 10-year futures, 60 seconds before the CPI report actually came out. So we will definitely get into that. And then, of course, we'll jump into all of the details stemming from the FOMC meeting, the details on the summary of economic projections, which is really what was responsible for the market rout today, as the market absolutely got shellacked. We obviously did a live stream of this yesterday, and towards the end of the live stream, there were questions about why is the market not tanking some more. And I was saying that there could be a delayed reaction. Also, during the binary event, you're getting a lot of hyperbolic trading, shorts and longs going, canceling each other out all day. However, when the market actually digested this information, it did not like what Jerome Powell and the rest of the Fed members had to present. So we will go into all of that, what that means for your portfolio, and dive into some of the plays that we took today in light of what was uncovered yesterday. And just a reminder that if you're seeing this before December 17th, we are having our mastermind open to the public. This will be a live webinar. We're going to be going over liquidity basics, how to trade like the banks, futures versus options, how to size your trades, and when to take profits, as well as a Q&A towards the end. This is absolutely free. So if you're not signed up yet, spots will fill up, and once they're done because we can't allow more people than the limit in the Zoom calls. So click on the link below and sign up for the absolutely free webinar. It's going to be Saturday, December 17th at noon Eastern time. Look forward to seeing you guys there. And without further ado, let's get right into it. So there might have been some insider trading earlier this week before CPI. Now, I normally am not the tinfoil hat type. And because I've been studying the markets for almost 2 decades, you normally see a lot of hedging, a lot of bets placed right before binary events. Ourselves, we opened up 2 strangles, one right before the CPI and one right before the FOMC meeting. And you can see the volume of these contracts, especially options contracts, going up. However, where there was suspicion was in the 10-year Treasury note futures. Usually, the futures associated with Treasury yields are extremely muted, and you don't see a ton of bets because bond investors and bond traders usually wait for information to come out before making bets on where they think the 10-year Treasury or the 2-year Treasury or whatever Treasury, where those values are going to be. But up to a minute before the CPI was released, there were 13,000 of the March 10-year futures traded. As I said, this is usually a period when activity in this specific instrument is non-existent. And on this day, the 10-year futures, you can see on this green candle, actually soared almost 8.5%, which is a large move for Treasury bills. They're not like stocks, right? This might seem like a low amount to stocks, but it is a huge gain if you're talking about Treasury futures. So that is definitely suspicious activity. And really, I wish our government officials would stop sweeping this stuff under the rug, because when Corinne Jean-Pierre was asked about it, she just basically said that there was no way that the information could have been leaked, but there's no way for her to know that. And regardless of administration, there seems to be this suppression of a need to investigate this stuff, because, at the minimum, there should be an investigation, an independent investigation held when stuff like this happens. If her or any White House official isn't aware of any leakage, that's fine. You could say, I'm not aware of it. But this stuff definitely should be investigated. There's no reason why it shouldn't be. With that said, we all know that there won't be, but I just have to highlight it because I do have a platform and I want to make as many of you guys aware of it as possible. And hopefully one day this stuff actually does get investigated when we see suspicious activity like this, because the data pops up, right? It's not like you can easily hide this data. You see the number of contracts in almost any instrument that's tradable on the market. So there should be investigations when things like this happen. And if they don't find anything, they don't find anything. If it was just some bozo making a large bet, fine. But it is rather suspicious. Anyway, let's get into the FOMC meeting, the summary of economic projections, what that means for the market, and what levels am I shorting at, what plays am I taking. So let's dive into the summary of economic projections at first. Here's why the market actually started tanking today as of the time of this recording. Now, I summarized some of this on my Twitter account yesterday. By the way, you should follow me on Twitter and Instagram. I post daily finance and trading content for free, but obviously everybody knew that the Fed was going to do 50 basis points. However, what wasn't expected was the dot plot. The dot plot is essentially where Fed members are betting that the Fed funds rate is going to end up next year. And they basically put these little bubbles that look like this in the range that they think the Fed funds rate is going to end up at. And the Fed funds rate is the actual thing that the Federal Reserve is hiking, right? That is the interest rate that the Fed is hiking. So the surprise came out when 17 of the 19 members put the Fed funds rate at above 5%. This was much more than expected back when the last time that the Fed released the summary of economic projections in September. So if you look at for 2023, this blue dotted line is where the Fed members were projecting during the last September meeting. And right now, this is where the Fed members are projecting the Fed funds rate will be. So 5.13 to 5.37 is the consensus for 2023. And we even have a couple of Fed members going up to 5.87% on the Fed funds rate. So much, much higher than what was initially projected for September. So that was the first reason that the market actually took this as a very hawkish presentation. Now let's jump to the unemployment rate. Remember, the Fed is trying to push the unemployment rate higher because that leaves less money in people's hands, which means less spending, which hopefully they think will curb inflation. It sucks that that is one of the methods used to curb inflation, but that is the system that this country is based on, right? So the unemployment rate, as you can see in the blue dotted line, was projected back in September to be somewhere between 4 and 4.5%. However, now the consensus for 2023 is that the unemployment rate will likely be towards 4.7%, so a whole percentage point higher than where we are today. And Jerome Powell said yesterday that inflation is a lot stickier than they thought would be at the end of 2022, and that is true. If you look at their projection back in September, they thought that at the end of 2022, PCE inflation, most of them thought would be between 5.3 and 5.4. And now we're getting anywhere between 5.5 and 5.8. So PCE inflation a lot stickier than the Fed actually thought it would be. Surprise, surprise. So that sent the markets absolutely nosediving today. Still from that level that we've highlighted for months, right? This level on the S&P 500. Nosedive today because the messaging from the market is that the Fed is actually going to overdo it. We did get some more data points today as of the time of this recording that shows that the November retail sales suffered a larger drop than expected. We also had weak regional manufacturing data. And if we look at mortgage rates, they dropped for the 5th straight week. So this is all intentional, right? This is what the Fed wants. However, unemployment is still 3.7%. So we risk actually running into a wage price spiral, right? Where wages continue to grow, but we also see stagflation where inflation remains sticky, but economic growth remains slow. This is why, as you see on this chart, by the time that the Fed actually pivots, shit hits the fan, because the Fed is not going to pivot until it has defeated inflation. The problem is that defeating inflation means raising the rates too aggressively. But, in the way that our financial system is designed, raising rates too aggressively is going to break things. It's going to increase unemployment, so more people will be unemployed. It's going to decrease spending, which means less profits, less revenues, less earnings for companies. It's going to make everything more expensive, not only from the consumer side, but also from the business side. So the economy comes crashing really to a halt. And that is why by the time the Fed pivots, it's when their job is done. And by the time the Fed pivots, shit has already hit the fan. So we tend to see the markets tank. Obviously, we tend to see the treasury yields tank at that point, and we are usually in a recession. So we are seeing the early signs of that. And that is what the market is currently responding to, right? We're finally starting to see a drop in these things, which is good and bad. Is good because it shows that the Fed is actually, what they're doing is working, but it's bad because the rate that the stuff is going to crash is really uncontrollable, right? Like, these are blunt tools, and so the chance of overcorrecting is almost 100%. We've never achieved a soft landing. Never in the history of the Fed or the history of this country have we achieved a soft landing when dealing with interest rates and the Fed balance sheet. And I shared this chart on my Twitter yesterday. Again, follow me on Twitter. I do share a lot of valuable information, but the Fed funds rate, the last 8 times that inflation was a problem, going all the way back to 1974, the Fed funds rate had to climb above the inflation rate significantly. There's a error on this chart, by the way. The pink is supposed to be the black and vice versa. The pink is the Fed funds rate. Black is the CPI rate. So every single time the Fed funds rate had to go well above CPI rate in order for inflation to get tackled. And we're just a far away from that now. The current Fed funds rate is between 4.25% and 4.5%, and the CPI rate is currently 7.1%. So the Fed funds rate has to come above the CPI rate eventually for there to be a Fed pivot and for inflation to be combated. So with that said, how do I think the market will react to this? Well, I don't think that we've actually seen the effect of high unemployment and muted earnings yet, right? So I do think that it's likely going to be pretty messy here, but we will eventually revisit the October lows and potentially go lower. Again, I'm targeting the pre-COVID highs as the next point at which I will buy stocks, but it will likely be very messy. You can already see that we've spent 2 weeks at this resistance level here, much longer than we did back in August, much longer than we did back in March, and much longer than we did back in January, every single time that we've hit this resistance level on the S&P 500. So I am likely going to be scaling into shorts in the form of debit put spreads here against my portfolio. And I will buy those debit put spreads with a comfortable expiration in February 2023 to allow me enough time to maneuver and scale in more in case we will see, a lot of chop here. Like, we may revisit this trend line, we may trade sideways for a while. So I do want enough time for those hedges to play out. But I do think that we have not yet seen in the January earnings, we will likely start seeing the effects of a slowing down economy, but it still might not be enough time to reflect what is going on, and what the Fed is doing could really be start to be really reflected in the March-April earnings. Anyway, traders, that is it for this video. Again, if you're seeing this before December 17th, free webinar, our free mastermind, the only time that we've ever done this. Click the link in the description, and good news for those members that join, you will be able to take advantage of 25% off. This is our year-end pricing before our prices are actually increased next year for 2023. So if you join that call and you decide that you want to join the Academy, you will be able to get 25% off lifetime memberships right after the call. You will be emailed that offer. Let me know down below, what did you think of the FOMC? Do you think that we'll be in a recession? Do you think a soft landing is possible? Why or why not? Would love to hear from you guys. Hit that thumbs up if you got anything out of this video. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.